I am Dr. A. Sairam, MCom, MPhil, PhD, UGC NET in Commerce, MBA Finance, Post-Graduation Diploma in Financial Management and ICAA Final. Welcome to my channel, Professor Guru Kalvi. This is a channel where you can find all e-content related to commerce related subjects. In today's video, we will be looking at the journal entries that are related to a buying company. In previous video, we were discussing on the journal entries related to a selling company. Now we will look at the other side of the journal entries. Here we need to understand one important fact. Journal entries in selling company is journal entry in separate books of accounts. Journal entry in a buying company is a journal entry in separate books of accounts. These two books of accounts related to two different entities. In case of selling company, more than one entity. In case of buying company, one entity. So students should not confuse between that journal entry and this one. Both are entirely different. Come, let's get into the video. So first journal entry is for purchase of business. Journal entry is business purchase account debtor to liquidator of selling company. As we all know, there will be a person who will liquidate, who will transfer the assets and liabilities, who will sell the assets and liabilities, who will revalue the assets and liabilities, who will take up the legal procedure of transferring the assets and liabilities from one company to the other. That particular person is called as the liquidator. So he becomes, since the selling company has lost its identity, okay, now we cannot enter its name in the books of accounts. So what we do, we enter the name of the liquidator. In a sense, we call him as liquidator of selling company. The first journal entry is business purchase account debtor to liquidator of selling company account. The next one is for taking over the assets and liabilities of this purchasing company, in essence selling company, the other company. So the sundry assets such as land and building, furniture, plant and machinery, stock, sundry debtors, bills, receivables. So all these assets are taken over, and goodwill, if any, is also taken over by the buying company. So it is entered on the debit side. It is a debit balance. Asset will always appear on debit side. So journal entry is sundry assets account debtor, goodwill account debtor if it is there, to liabilities that I have taken over. Sundry liabilities, it might be sundry creditor, bills payable. So these are some of the sundry liabilities that I have that I will be taking over. And the business purchase is what I have bought will be recorded on the credit. So journal entry will be sundry assets account debtor, goodwill if any account debtor, to sundry liabilities account to business purchase account. Okay. The next journal entry is capital reserve if it appears, if it arises from the new purchase. So sundry assets that I have taken over to sundry liabilities that I have taken over, then the business purchase that I have that I have agreed to pay. It will be either by way of shares or debentures or bank, whatever it is, to capital reserve, the difference of amount between debit and credit here. So the two journal entries that we have seen so far are business purchase for purchasing the new business is business purchase account debtor to liquidator of selling company. The next one is for taking over the assets and liabilities, where sundry assets account debtor, sundry in a sense it includes all the assets that I have taken over from the selling company. Then goodwill, if it is shown in the question, then we have sundry liabilities. Once again, It does not include internal liability. Do remember it. It includes all external liabilities to business purchase account. Then we have capital reserve if it arises. Sundry assets account data to sundry liabilities account to business purchase to capital reserve account. The third journal entry is for purchase consideration payable in cash. Liquidator of selling company account data to bank account. If the purchase consideration is by way of shares, liquidator of selling company account data to equity share capital account to share premium if any. If the purchase consideration is payable by way of debenture, liquidator of selling company account data to debenture account. So, 3 journal entries for purchase consideration is liquidator of selling company account data to bank account. If it is shares, liquidator of selling company account data to equity share capital to share premium if any. If it is debenture, liquidator of selling company account data to debenture account. If all three occurs, all three kind of payment happens, liquidator of selling company account data to bank account, to equity share capital account, to share securities premium account, to debentures. Now we have recording of expenses of amalgamation, amalgamation expenses account data to bank account. For adjustment of amalgamation expenses, we have general reserve or P&L account data to amalgamation expenses account. So these are some of the journal entries that we will be looking at in case of a buying company. Dear students, please understand a fact. Understanding properly, reading the question properly is the fundamental thing that we need to do as far as amalgamation, absorption and external reconstruction is concerned. Do not be frightened by the fact that there are many journal entries. How I am going to keep all this in my mind? As I have explained you properly, you just understand the journal entry, it will automatically be recorded in your mind. So thank you for this wonderful opportunity. With the grace of my Guru and his blessings, you all will reach greater heights. Thank you, students. We will meet back in next video.